From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Hello, this is the COB, all the stuff you need to know in the day in business and markets. I'm Kyle Roddy here, of course, with Danny Akirye. Our first stint for the week. It's great to see you.
Absolutely, great to see you too.
Yeah, well, I mean, we've got to get a little bit of, I suppose, sweet talk, banter, small talk, because there's not much going on out there at the index level for the market, it has to be said. We're down today, but again, it seems to be that we're just sort of struggling to find a catalyst, perhaps a direction. Certainly seems activity is a little bit lower than, well, perhaps what we've been used to.
Yeah, I guess people are just sitting on their hands at the moment. There's so many potentially major market moving events coming up, in terms of, dare I say, that debt ceiling, where inflation goes, we're higher for longer, we're going to have another rate rise here in Australia. Is the US going to go in June? My gosh, I'm sure people have never talked that much about macroeconomics and had such a crash course as they have literally in the last year.
Absolutely, yeah. I suppose inflation will do that. But let's get a look at the CBO 200 just very quickly. And well, it seems that we're having issues with that chart, but we'll just have a gander at
it's down about
the screen.
0.4%. I've got the ASX 200 currently, but it does take a while to update, about 26 points. Materials very strong. That was BHP, but also James Hardie, which we've been discussing all day long. That was strong. Also a little bit of love in some of the lithium stocks. I noticed Morgan Stanley said they thought the price was going to start to improve as the inventories had come down. And a lot of weakness sitting in the defensive stocks, the healthcares, the Woolworths, the Coles, and of course they've all been really strong performers lately. So probably it's this ongoing rotation that we're seeing in markets.
Yeah, and so only two of 11 sectors finished higher, materials and energy. The rest were lower. Let's get to the three themes though, because again, it sort of crisscrosses the macro and the micro. Nobody moved. Seems to be the way people are playing this environment at the moment. But finally balanced. We got the RBA's minutes today. Actually, a bit of macroeconomic data today, and the decision, as it was described in the minutes, was finally balanced. They decided to go 25 basis points, and well, we did have some consumer sentiment figures and
which
consumer
aren't great.
Confidence figures out today too. The ANZ print falling to lows not since April 2020, which kind of gives me flashbacks thinking about it. I don't like remembering.
I think we were all
days.
locked up then.
Yeah.
Nobody liked that.
Yeah. No. I was in Melbourne. That was a grim 2 years.
Oh, that was very grim. Yeah.
It was dreadful. So anyway, that's the kind of scale of I suppose the drop in confidence that we've seen recently is that people are feeling as bad as, well, actually I was talking to Adelaide just over Twitter before about the numbers, and she said, when people were expecting double-digit unemployment in the country, when we got into lockdowns and there was no stimulus yet and all this stuff was going on, that's how bad we're feeling, it would seem, at least based on this survey. We always like to ask this question too. And I know you actually had a guest on a little earlier that probably answered it better than anyone could.
China.
What's going on in China?
Yeah, so we did. We had Global Asian Strategist from HSBC, Frederick Neumann. Clearly the government is going to have to stimulate again. He is looking for stimulus to come through, not of the magnitude that you saw in 2008-9, but they really probably, Beijing and China, the PBOC put some money to get housing going, get the property developers going, because the retailer, basically services, so travelling's doing very well, the high-end consumer, but there's a lot of structural problems in China at the moment with the middle to low-end consumer not having any money. There's still employment problems. So patchy recovery, the numbers yet again weak, or weaker than expected. Weak is a strong word when you grow at 18% retail sales, but not what they wanted. So he is basically looking really for more stimulus to help boost that economy. And obviously the US, if it goes into recession, is going to cause, not coming at a great time, and ditto for the rest of the world, for China.
I've got a wild theory that I'm sort of letting ferment in my head for a view, which is just about the concerns maybe China's policymakers have about financial stability risk abroad and how it could affect them locally. Just a few interesting research papers that I've seen hit the inbox lately, talking about just little ways that policymakers are tinkering with China's financial markets, with their banks, to make sure that they're, well, fairly stable. But I mean, if you look at like the PPI figures last week, the CPI figures, in principle, they probably should be stimulating now. Certainly, they'll probably start exporting deflation to the rest of the world. But perhaps avoiding making the job of any other global central banker any more difficult by perhaps stimulating themselves, and then obviously putting any further pulse or pressure up in terms of inflation globally. Anyway, that's going to be my wild idea to let sort of cultivate in my head over the next few days. But let's look at some of the corporate news today. James Hardie was probably the biggest one. I don't know if you had a chance to look through the results, but it certainly
margins were much better.
Yeah, it kind of put to one side that the world is ending trade there, for at least when it comes to the US economy and US housing market for now.
I think they have been very preemptive about cutting costs, and they also, I think they, had that pull through, or a bit like the tech companies. Staff were laid off, and they've been very preemptive, expecting this slowdown in US housing. The outlook isn't great, and they did say that very much nothing is going to happen in the US until the I suppose the consumer realizes that the Fed's not going to raise anymore and maybe start to drop rates. So definitely better than expected. The market really liked it, but they're not out of the woods yet.
No, not by any means. And we had a broker upgrade to Aristocrat Leisure that was upgraded by $4.
It's been a great performer, that one.
Yeah, down a little bit today, but like you said, a really good performer. Pro Medicus as well. Didn't move too much, but signed a new contract with Gunderson Healthcare Systems. You can see there just some of the mover and shakers. Appen. Well,
it feels like it's a last gasp for Appen, going to the market with these depressed share price levels, trying to raise capital. I mean, it certainly would not be the first choice, would it, to raise equity when your share price has been absolutely pummeled. So I don't know. It's probably, maybe not a last gasp, but I'm sure some shareholders are asking some serious questions of management.
Well, yeah, I mean, it seems sort of throwing, good money after bad, I guess you could say at this point. But of course, well, actually, we didn't speak to CEO Chris Hull. You spoke to CEO Chris Hull from Live 360 a little earlier today. And I mean, that was the biggest mover on the market in the end, up around 11.5%. Anything you took away from that in particular? Yeah,
so their cost out programs have worked really well for them. The integration of Tile is going really well. They've got the millennials that are the digital natives that are now starting to have babies, and of course that is all very positive when you want to connect and watch them and watch your dog and your cat and everybody else, and they have their Tile and off they go into the Life 360 walled garden. Software as a service, the family package. Yeah, so he was really upbeat. They are making profits. They are cash flow positive, which is really good. It's a quarter before what they're expecting. And they're doing big launches into the UK and also to Europe. So upbeat.
Yeah, you can be a helicopter parent from the comfort of your living room. Well, we did actually have a conversation with Chris Hull, CEO of Live 360, a little earlier. Here's what he had to say about the results.
Obvious takeaway is that we reached cash flow break even and positive adjusted EBITDA earlier than planned by a quarter. Internally, we're not surprised about that. We've always felt we've had a lot of operating leverage in the business. We've known that we can grow organically with very little marketing spend, but obviously having confidence in doing something versus delivering the results is quite different. And we are very proud that the company is now essentially generating operating cash. And we have a ton of upside as we continue to push on some of the new features, such as including hardware devices in our bundles. And on top of that, seeing very good international results, which we think will bode well to our full rollout of the broader Life 360 membership in the UK later this year.
Okay, so you could hear there from Chris Hulls just in terms of what he thought of the results. And of course, always very generous with his time, Chris. So we do appreciate him calling in from I think he's still in New York, in fact.
No, or San Francisco.
Well, San Francisco, sorry. He was in New York when I spoke to him last time. Anyway, James Hardie, we spoke about it a little earlier on, some of the results there. It was our stock of the day. We'll jump straight to it now. Here's what our guest had to say about the outlook for James Hardie.
Honestly, the outlook is pretty good, and I think that the real question for investors is where does James Hardie sit in the economic cycle right now? Because again, if you're looking at any share price and how much do I pay for this business, the answer is usually should be at least a question of how much the long-term earnings power of this company is worth. So I don't know how sustainable the current level of earnings is, mate. So I'm a little bit concerned, I have to say. If you look at the company's current PE of 18 times, I would be a little bit higher now, but again, of course, future earnings hopefully higher as well. I don't want to pay 18 times for a cyclical business at or near the top of its powers.
This stock kind of encapsulates the arm wrestle that's going on in the market at the moment, where every man and his dog has caught a recession and is wary of the stocks that are exposed to a downturn in the economy. And these stocks are actually, they're not shooting the lights out, but they're surprising investors in how well the business's earnings are holding up. I'll say a hold with a recommendation.
Fair to say mixed there, a bit of sort of a hold overall for the company. But well, fortunately, we also have someone else with an opinion on James Hardie. Martin Craig from Shaw & Partners joins us at the desk. And actually, as we were walking in, Martin, welcome along. It's great to have your company, of course.
Thank you.
It was your sort of stock of, correct me if I'm wrong, stock of the year, was that what was the phrase? Your pick of the year at the start of the year?
Well, the good people at Ausbiz contacted me at the end of last year and asked if I'd do a 30 to 60 second video grab on what my stock for the year was. So my previous one was South 32, the one before that was Santos. So not bad track record, single stock portfolio. So yeah, Hardie's was my number one. And really, some of the stuff we saw in the result today is the reason you want to own it. The short-term outlook's horrible, right? The US housing market's on its knees. They said it's going to fall another 15, 20% this year over last year. So why would you buy a housing stock if the housing market's collapsing? And it's about the discounting mechanism that is the Australian share market. We are looking 18 months out. We're not looking at 2023 or even 2024. We're thinking about 25, when inflation will be under control, growth will be improving, interest rates will be getting cut, and we have a massive underbuild because of all the net migration that's going on around the world. So we need to find homes for 1.5 million people in the next 5 years in Australia. God knows what the number is in America, but it's going to be tens of millions of new homes need to be built. So you want to own home builders. Now, I sent you a chart, I'm not sure if you had time to load it, looking at the performance of the US home building stocks. They're back to their all-time highs. They're only 1.5% below their all-time highs of November 2020. The Aussie stocks that are in the US, which is Hardie's, Reliance, RWC and Reece, REH, they're all in the US housing market in one form or another. They're still well below. They're still 30, 40% below. So the black line is an index of US home builders. And as I said, it's back to its all-time highs. The Aussies are still 40% behind. So I'm not saying that gap's going to close tomorrow, but it's a bit of an anomaly there. So there'll be money moving out of the US home builders into the Aussie listed US home builders, and James Hardie's probably the biggest one of that. So we think that's a no-brainer. That stock can go a lot higher than where it is today.
Yeah, you've really good points, and it's a quality company. You know, management continue, don't they, to prove themselves.
Well, they've got a
through
superior
the cycle.
product. So fibre cement's a much more superior product than vinyl, and Americans predominantly use vinyl to clad their house, and it's obviously very energy intensive, and it's also flammable. So why would you want to cover your house in that when you can use the fibre cement product? They've got patents over fibre cement going out forever. So it is a technology play. It's hard to think of fibre cement as a technology play, but they have patents all around their processes, and they make 25% EBIT margins, which in the building industry is unheard of. So it's a really good quality company. It's had its problems in its history with asbestosis and so forth. So it's not without warts, if you know what I mean. But we just think it's a stock and they go a lot higher.
Yeah, wow, absolutely. Maybe have a look at what the RBA said, Martin, in terms of their May minutes flagging. I mean, there's a lot of data still to come out before the next meeting. I was just having a look, unemployment, retail sales, etc. But another rate hike on the cards, do you think?
People have started adding them back in. So if I rewind 6 weeks ago, everyone had removed rate hikes from the agenda, and it was always a matter of when are they going to put them up. Now the curve's now moved back the other way. So I think NAB are now going for 4.1. UBS, who we're close to, they're saying there's now risk of another one. So people are starting to move back towards 4% rates, and you can just see the cash futures there are definitely pricing in the probability of at least one more rate hike, because you can see the September and August contracts there around about 4%. So maybe a 50-50 chance of one more hike. But as I showed there 4 weeks ago, we were looking at 3.6 going down to low threes by the middle of next year. So for those of us with mortgages, Colin, and I know you're in the same camp as me, that is not good news. But the issue, the RBA, it's clear that it's really, really close neck and neck on these decisions. When the Fed votes, it's unanimous. There's rarely a dissenter. There used to be one or two, but there's usually 16 governors who all vote the same way, and they've got this real clarity around monetary policy. In Australia, even though they don't disclose it, they've mentioned it in the last 2 minutes of how close the call is, and it's like 5 to 6 or similar, right? So the decision to pause was one vote. The decision to hike is probably 1 or 2 votes. So there's real, I suppose, lack of cohesion within the Reserve Bank as to what to do about monetary policy, and there's a lot of people sort of sitting either side of the fence. So it seems to be that the wage price index we get tomorrow, and then the employment data on Thursday, and then we don't know when the wage decision comes out, the Fair Work Commission on minimum wages, because that sets award wages as well, when that comes out. But there could be 3 data points coming out the next few days that swing the RBA in either direction. But at the moment, it looks like the betting is for another rate hike. One of the reasons you saw stocks with interest rate sensitivity getting knocked around today, so long duration stocks, growth stocks, very interest rate sensitive, they all got knocked around this afternoon after those minutes came out.
And let's take it to the consumer now too, because I know that you've been sort of fairly cautious on consumer stocks.
Yeah.
And I mean, if there's any kind of very crude indicator that we can look to, it's just these figures that we got out of ANZ and then particularly Westpac, the monthly read today.
Yeah.
Confidence is obviously just completely in the doldrums.
Yeah, it's at GFC levels, which is odd because I recall the GFC, there was lots of unemployment, interest rates were really high, there was a banking crisis, there was runs on banks, there was banks going bust all over the place, and the consumer is as negative now as they were back then. So this courtesy of the good people at Westpac Economics and the Melbourne Institute, just showing, look, it's bouncing around. You can see that it's moving like 10 points a month, which is quite volatile. So if the RBA cuts rates or goes on hold, we all get excited. And if they hike rates, we all get pessimistic again. And at exactly the same pattern as during the GFC. You can see there was months there where people got a little bit more enthusiastic and then they got smashed again by yet another catastrophe. So it kind of feels like that sentiment suggests that retail spending should be slowing dramatically. As you were talking to one of your guests earlier, the gentleman from McGrath Nichols, people are still spending money, right? There's still cash in accounts. Rich people are getting a pay rise because of higher interest rates. So there's still lots of spending going on, but that suggests that that's about to fall, off the edge of a cliff. We're all waiting for that to happen, but we haven't seen signs of it happening yet.
We don't have the chart, but you put up a really interesting chart on LinkedIn yesterday about where all those bank deposits had gone and the magnitude.
Yeah.
What, which I'd love you to touch on, but what caught my eye, that this movement into money market funds in previous historical periods actually preceded a couple of really nasty economic periods and crashes, the dot-com bust and the GFC.
Yeah.
So maybe you could just talk around that chart, and people can go and check it out on the Shaw LinkedIn page.
So what tends to happen in the US, a slightly different market to us, is that banks don't tend to pay interest on checking accounts, on deposit accounts. So when interest rates go up, a lot of investors, well not a lot, but some investors move their money from a bank deposit to a mutual fund or money market fund, which does pay a higher rate of interest. The problem for banks with that is if your deposits are shrinking, you need to shrink your loan book to offset the shrink in deposits. So it has an effect of tightening credit. So even though it's perfectly natural and it's what rational investors should do, if you're not getting paid money by the bank, put it in a money market fund. It's not guaranteed in a money market fund, but the banks, that's something you need to trade off. But so a whole bunch of money moves out of the banks. It's about $1 trillion has moved out in the past 12 months, which sounds like a lot of money, but during COVID, $3 trillion went into bank accounts in 1 year. So a lot of that money's just been sitting there, now it's coming out. But it tends to precede tightening of credit because of that issue of all of a sudden a bank doesn't have the deposit base, and think of Silicon Valley Bank and First National, etc. The deposits dry up, they have to shrink their balance sheet. Well, they actually got shrunk by the FDIC, but the same thing, right? So it does actually have an impact of taking liquidity out of the financial system. Although the money stays in cash, it stays in a different form of cash.
Yeah.
So that kind of almost sends us all the way back to the start. And I know Danny and I were talking about this at different stages. Is just what sort of issues exist on these banks' asset sides as well? Because there's the sense that this issue with commercial property, even just what's happening from almost like an accounting point of view, with the sort of high quality liquid assets being sort of written down because of interest rate rises. Are we also concerned about those issues too, or are you concerned about those issues too, and the knock-on effects that will have onto credit as well?
Yeah, I mean, I think that's probably played out. That was kind of played out through March. And I think the fact that the regulator and the central banks, and there was a coordinated central bank action around this as well, to provide, infinite amounts of liquidity to any bank who may be having a deposit run, including putting your long-term government treasuries back to the Fed at par value, even though they were probably 75 or 80 cents on the dollar. Like a 30-year bond's probably fallen from its peak something like 30 or 40%. So if you have to liquidate that today, you're going to take a big haircut. So they said to banks, well, you can put it back at $1. You don't have to put it back at 70 cents. So I think that provided enough liquidity to avoid the sort of bank run, and we've now moved back. So that H8 series that the Federal Reserve publish every week that looks at deposits, that's stabilised now. There's not more money going out. There was that huge drawdown that we spoke about, but a lot of that was money moving out of Silicon Valley Bank and into other banks, so it's kind of circular. But I think the change in interest rates, not concerned about financial stability, is what's driving deposit flows. So from a systematic point of view, I'm not concerned about the US financial system. Some investors were, because we're just going to see more banks go broke, but I think we're beyond that now. And JP Morgan get tapped on the shoulder like they have done for the last 200 years. Go and buy the banks if something goes wrong. So I think I'm in my head anyway moved beyond that as an issue. We still need to be cognizant of it. I don't think it's a systemic risk like it was a couple of weeks ago.
Martin, really appreciate your time as always. Managed to get 10 minutes of conversation out of what was otherwise pretty quiet day. So
there's always lots going on, mate. There's always lots going on.
Martin Crowe from Shaw & Partners, thank you so much for your time.
Thank you.
Okay, let's get across just some of those leaders and laggards. Starting with the leaders, and of course, we have spoken about who they are and why they are higher, of course, but we'll touch on it again. Live 360, a solid set of results, and I mean, I've always thought about these sort of tech companies, right? It's the elegance and simplicity, right? Like, you can have these sort of very, very highfalutin ideas when it comes to, world-changing kind of applications and technology that, can do this, that, and whatever. But this is a simple idea and seemingly really well executed. People can understand it, people want the product, and clearly it's translating to some success.
What was really interesting of why the Tile acquisition was so significant is that people don't want to pay for an app. So the fact that you get a piece of hardware to track everything from your wallet to your cat to your dog to your your kid, whatever, the fact that they get a piece of hardware is enough of a hook or an inclination to go into their software as a service, a payment scheme, to become a family member, etc. So I actually thought that was really interesting, because by definition people go, why should I pay for an app? So they've been very clever in monetizing their app.
And finding ways to sort of generate recurring revenue, I guess, as a result, right? That's so interesting. James Hardie spoke about that a lot, up 8.6%, seemingly shaking out some of the bears there. Telix Pharmaceuticals back at the top of the table once again with a 3% rally. Silver Lake has been in focus too over the last few days. Let's look across at the laggards as well, as we must. Imugene, always volatile, and we did speak about how some of those healthcare names were, having a sort of a tougher session, perhaps, if you will. Obviously, it's typically a much more volatile stock, Imugene. I don't know if I can find any news in particular, actually, as to why.
I thought it was quite interesting. For a while there, we actually had some of the auto-related stocks. So I've got Eagers up, AP Eagers up there, or Eagers Automotive down almost 6%. And ARB was also up there at one stage, and GUD. But we've also got the wealth providers, Hub24 and Netwealth, also off by almost 5%. I just thought it was quite interesting that maybe to Martin's point of interest rate interest rate sensitive sectors being hit today, because obviously higher rates, not necessarily good for stock markets, maybe people taking a more negative tone towards inflows or outflows with those wealth providers, and two, car financing costs going up in the absence of any other information. And poor Elders continues to struggle, down another 4% under $7, and really that stock does not have a lot of love at the moment, does it?
No, when I was speaking, and the folks who would have listened to the podcast yesterday, Nathan Summerson-Dara from D-Data Analytics, he's been sort of a bit of a permaball, I mean that affectionately, of course, on Elders is a bit of an ag play. He's chosen ag play. Sort of spoke about the technical dynamics can often drive the price lower in the days after these results that were obviously disappointing as they were, more or less the broken notes start coming out, the retail investors start going, oh, holy cow, that wasn't so good, we'll sell as well. So might be a few days of pain for Elders investors there. He was, of course, very bullish on the sort of ag theme there. Nevertheless, but of course, still in your bottom 5 today. And the small caps.
Oh, wow.
Anything in there? You've got the Ikuye Family Office Small Cap Fund?
No, Austrat Materials, no idea, but up almost 19%. Magnus Energy Tech, up 9.3%.
There you go. No. Next one, 5 Advanced. Group 6 Metals, Reese Pharmaceutical, some of which has been spelt... has been popped up there by a certain member of the team, I can tell.
Are you inferring someone has dyslexia? I didn't write that one, but I would put myself in that category.
Yeah, me too. I'm just a kid with the ADHD, of course. But let's get to what's on overnight, shall we? Because there's actually a fair bit going on.
What is on overnight?
Well, I think the US retail story is going to be interesting for a few days, because we get the official data, but tonight we get the likes of Home Depot. In days to come, we get Walmart
Home Depot
as well.
is really important. I think a lot of people are looking to, Home Depot, Walmart, maybe Target as well coming out, not 100% sure. So along with US retail sales, to get an idea of how that US consumer holding up. Did you see US dollars 17 trillion in debt was announced by the US consumer? How much they've put on credit cards.
Is that right?
Yeah, it sounds huge, but most of the talking heads weren't too fazed by it.
No, and it's probably because it's not on their credit cards. But anyway, let's move on. And there we go. That's tomorrow. Australian wage price data,
Important.
Japan GDP, earnings reports, United Mall Group.
Yep.
And, is that IDP Education? No.
No, it's Incitec Pivot.
Incitec Pivot. I don't know why I even have my
Or
glasses on sometimes.
Incitec Pivot.
Incitec. What would be the proper Queen's English way of saying it?
I have no idea.
I have no idea. Incitec Pivot.
Should we go frightfully posh to say goodbye?
Well, maybe we shall. I mean, it's past, we probably should. Remember, you can catch up on all the news and interviews from today on your website and app. Danny, otherwise we'll see you tomorrow morning.
Absolutely. Bye, everyone.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.